Hello. So today we are going to go through certain aspects of trading, including just a general start for retail traders to understand what they're getting themselves into. Today's subject is the market is an auction. So very, very simple. The market is an auction. Price is not chaos, it is an ongoing auction searching for balance. There's buy and sell orders every single day from retail traders and institutional banks, and they try to find a certain equilibrium price when a buyer and a seller at the same point decide to purchase or sell their share of a security. Markets are structured systems, not random movements. Sometimes there are certain liquidity pockets and other things in the market, but that's for farther subjects where the market would want to go farther up or farther down, trying to find this laying liquidity. And there are a bunch of orders that still are from the Asian market or previous days or previous weeks. And it attempts to hit those marks and then move back into the different um, or and then it chooses to either move with that market in that area. It just tries to go to that exact buy and sell point. Price exists to facilitate trades between participants, and that is, for example, let's say Tesla is at $100, then you have somebody that is trying to buy Tesla at $100 and somebody trying to sell Tesla at $100. Every candle represents agreements between buyers and sellers. That's kind of the example. And it always has to be a buyer and a seller. Otherwise, you see these small pockets where there's just nothing there, no candles, nothing really is happening in that area. And that's called a fair value gap because the market just shoots up all this way. And usually the market comes back down and fills that entire area with orders of buyers and sellers at a farther time in the market. Movement occurs when agreements break. That is also correct. It's kind of like the idea of order blocks and breaker blocks. The market will drop down through a certain area if the liquidity has been fully taken up, and then once more liquidity and there's more push and more incentive to move down into a certain area or move farther up into the market. Balance forms when participation increases. Very true. Less volatile if there's way more orders, so the market just stands still and kind of chops and moves sideways. Imbalances forms when urgencies dominate. Also correct. The market just moves farther up or farther down if there's a certain imbalance, more buyers are in the market, higher delta, those kind of things. Understanding price discovery removes emotional trading. And the auction logic applies to all markets and time frames. Higher time frames give you more decisive decisions rather than smaller time frames, because in 1 minute, if the candle goes all the way up in 1 minute, 100 points somehow, that doesn't mean it's going to keep going 200 points, 300 points up every single next minute. But if it's an hourly candle, you can kind of believe that the market's going to continue going farther down, or if the full candle is not fully closed, the market could come back to its mid-range. Why this chapter matters: most traders never learn how price is formed. Indicators explain what happens, not why. Confusing creates emotional decision-making. Logic creates confidence under pressure. Auction theory explains all market conditions. This framework supports every future concept. Understanding process reduces overtrading, which is very important to stay disciplined in these markets. What is a market? A market is a meeting place for buyers and sellers. Price exists to make trade possible. Every trade requires two willing participants. No transaction occurs without acceptance. Charts represents decisions, not randomness. Each price print reflects agreement between a buyer and a seller, a contract giver and a contract taker. And these just go extremely fast because there's hundreds and thousands and millions of orders each second. Markets are driven by participants. This is very easy seeable in cryptocurrency, it's kind of like the idea Warren Buffett said that you need a less smart person to purchase the next higher leg of crypto, because before institutions kind of ruined the idea of crypto, the market would go up 50 points, and every single time it would be another buyer higher, higher, higher up, called stacking, and push the entire market up hundreds and hundreds and hundreds of points to thousands of dollars. Buyers versus sellers. So buyers seek value below perceived fair price. They want to have a price point that is, let's say it's again a Tesla example, $99 is why they want to purchase it. So they put a limit order at $99. Sellers seek premium above perceived fair price. They want to buy it at 101 and then sell it at that 99 price to actually get a profit. Buyers push price up by accepting higher offers. That's kind of the crypto example. The market just keeps pushing and pushing and pushing and pushing. More buyers, more buyers, more buyers, more buyers, until they start selling, and that's when it slowly starts falling down. Sellers push price down by accepting lower bids. Aggression determines direction. How many orders come into the market can easily push the market up or down very easily, and that's kind of the idea of how much volume comes into the market. Acceptance causes movement. When a certain area is accepted over a level, then that area can become a new liquidity area with liquidity pockets, and more buyers and sellers want to be active in the market so that these orders will always be filled during those times, and you can see a lot more chop, and then slowly more momentum upwards or downwards depending on what the probability of the market is, which actually causes continuation. Price moves up when buyers accept worse prices, and that's how price actually moves. So when the sellers accept worse, and price moves down when sellers accept worse prices. That's kind of the contrast between buying and selling. Movement is caused by acceptance. Indicators do not move price. Participants move price, and that's kind of the idea of retail traders. Every single day, there's so many traders that are just putting a little bit of money into the market, which moves price over time. But when a big fish comes into the market, he looks for the good old areas of buy and sell orders where you can just stack a lot of money into it. And that's why you see when a market wants to reverse, there's a, let's say it's at a high point, it will be stuck in a small area for a little while, forming a search and destroy type of pattern. Let's say between 50 pips approximately. There's not a full probability on this, but you can kind of figure it out with enough statistics. And it will move sideways for 15, 20, 30 minutes, maybe an hour. And then slowly will revert because it runs out of volume. It runs out of more buyers that want to buy it higher and higher and higher. And at some point, it has to fill that fair value gap. And that's called a liquidity sweep. And that's usually sellers purchasing at a high price, then wanting to buy back up or sell their orders by purchasing on its way down. But most of the times, you got to really realize the market's not just traders every single day. There's a lot of retail traders, but it's truly just investors. More orders coming in, more orders coming in, more orders coming in. And how we have seen during this new administration, the market has been pumping like crazy. Indicators do not move price, which is very true, but you can actually find good areas to purchase and sell in those areas with these indicators that can help you indicate and see the market a little bit more with open eyes. Participants move price, volume reflects urgency, and speed reflects disagreements. If there's an IFEG, the market just drops really quickly, means that price is not accepted, failed auction, and that just leads to the market dropping or going farther up. The auction mechanism. So buyers and sellers constantly test price. Price discovery occurs at an agreed point. And these are the certain levels where it starts moving a little bit sideways, or this is very slowly moving up and down, 5 pips, 5 pips, 5 pips. Balance forms when both sides accept value. Imbalance forms when one side dominates. The auction never stops. It only relocates to new prices. And those are new liquidity pockets or liquidity that has been laying there for a long time. Price always seeks participation. That's why retail traders are so important. Balance and a fair value. So this is the point I've mentioned a few times. High participation from both sides. Buyers and sellers agree on value. Price rotates within a range. Time is spent, not distance traveled. Volatility compresses. Acceptance is visible. And market pauses before the next move. So certain times you can see a leg down, a little bit of a wait period, another leg down, and another wait period. If you look at the market most of the times, what you can truly see is kind of this idea that the market just goes up slowly, 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 then it goes slowly, slowly, slowly down, and all of a sudden you have this kind of break of structure and absolute little move downwards. These candles don't make sense in that image, to be honest. And it's a change of structure. Imbalances and unfair prices. One side overwhelms the other one. Participants drops on one side. Price moves quickly towards that direction. That's kind of the idea here. Price moves quickly, distance matters more than time, and market rejects current value. Opportunity increases and risk increases as well. The auction loop. Price discovery begins every move. Balance forms during agreements, imbalances form during rejections. Price searches for new participants, like here, getting more people back to the market. Slowly goes farther up. It's just stuck in this chop. Then all of a sudden from here, you see one final drop to get all these buyers back out of the market because it's kind of the idea that the market wants to start moving up. Final little sweep here. And that's a perfect entry. Then the market just starts reverting into the other area. Actually, right here is a very good purchase price because here you have somewhat of a confirmation. It's a change of structure, break of structure here. And then you have IFVG is filled. This is the IFVG or FVG. It goes this way. That's kind of the loop of the market. It has to go this way. Here's a true fair value gap that has to be refilled, and here it was filled. Those are kind of the interesting parts to it. Why price moves faster? Liquidity is withdrawn. One side becomes urgent, and they just want to keep shorting it all the way down or buying it all the way up. Sellers and buyers competing. One side becomes urgent. Orders chase execution. Market must move to attract trade. Speed reflects this agreement. Fast moves are unstable, and reversions often follow. Like in this area, the market just shoots all the way up, so then all of a sudden it comes all the way back down. Pretty much the same order, actually, yeah, pretty much the same time frame. This candle right here is as big as this entire move. And here, exhausted, back in its equilibrium price, reaches that VWAP, and goes back up. When price slows down, there's an agreement. Buyers and sellers agree on value. Liquidity increases. Participation rises. Rotation replaces direction. Volatility decreases. And that is this area. This price point is kind of fair. Market absorbs orders, and balance precedes movement. The retail mistake. Believing price is random, relying on lagging indicators, chasing momentum blindly, ignoring participation, trading outcomes instead of process, confusing speed with strength, and overtrading during noise. Like in this area, trying to go long right after this move can be correct, but you kind of have to have a very solid plan or structure. So this is good IFVG setup, where this movement right here, when it breaks this, is a good shorting opportunity because it could come right here, so you can set your stop loss right there. And then otherwise, a good thing that TJR likes to do is he goes into the market here because we see the sweep of London highs. This could be it would want to go right there. Once it breaks this, you can have a little bit of a profit target right there, or set it at London lows, not London highs. This would be an example of a liquidity sweep as well. And that kind of thing. And overtrading is one of those things that ruins your entire profits. So always be disciplined. The institutional view. Price seeks liquidity. For example, down here, this is probably some liquidity that's just still left there. So it buys up all this liquidity because it's accepted in this price point, and it shoots up. Market, advertise opportunity. Logic precedes execution. Risk is defined first. Emotion is removed from decisions. Process matters more than predictions. And consistency comes from structure. So for example, right here, a lot of people would have started placing their buy orders in the lower level and placed their stop loss at right approximately here. And then at the end, if you would have been in this entire move, you would have gotten taken out, maybe gotten luck by a tick, and then you would have made profit there. So you could have waited it out until there's a full confirmation. So patience is a virtue. Auction in action, price balances in a range, agreements eventually breaks, imbalances creates movement, and new participants enter. And that's kind of the idea right here. So then they entered through this level, and it's a very strong movement to the upside. Price stabilizes at a new value, kind of this area again. Here, this high, same exact thing. Then it does the exact same move, and it shoots back up and takes out all those levels for a liquidity sweep, and then it goes to the downside. Balance returns, price stabilizes at a new value, and the cycle restarts. Bang, boom, bang. Key takeaways: market operates as an auction, balance and imbalance drive price, acceptance creates movement, logic replaces emotion. This applies across all markets. This applies across all time frames. Understanding structure creates confidence. Now to the next chapter, which is in the next video. Hope you guys enjoyed. This is going to be a 16 video series. How do I? All right. Well, on to the next one. Hope you guys understand. If you guys have any questions, just leave it in the comments below. And I hope you guys have a wonderful day. God bless.